financial performance for the fourth quarter and the year ended December 31st, 2021. Revenue from operations adjusted for excise GST grew up by 30.3% year-on-year in quarter 4 2021 to the level of 17,343.4 million. For calendar year 2021, revenue from operations grew by 36.8% over the calendar year 2020 to rupees 88,232.3 million rupees. Consolidated sales volume for the quarter 4 calendar year 21 registered a solid growth of 28.5% to 112 million cases, and for the calendar year 21 total sales volume grew up by 33.8% to the level of 569.1 million cases, driven by strong recovery in demand and low base of the calendar year 2020. In the year 21, CSD constituted 70.3% of the mix, juice 6.4%, and packaged drinking water 23.3% of the total sales volumes. Realization per case for the calendar year 21 increased by 2.2% year-on-year, driven by improvement in realizations in international operations. On the profitability front, EBITDA increased by 20.5% to the level of 2,075.7 million in Q4 calendar year 21. For the full year calendar year 21, EBITDA grew by 37.7% to the level of 16,546.5 million rupees year-on-year. Gross margins in calendar year 21 declined by 288 basis points and by 476 basis points in the quarter 4 of the calendar year 21, primarily because of the higher PET prices, which increased by almost 18% in the year. Despite the decline in gross margins, the company was able to improve its EBITDA margin to 18.8% during the year because of higher operating leverage, driven by strong volume growth and on account of cost optimization measures. Finance costs declined by 39.8% during the quarter 4 calendar year 21 and by 34.3% in calendar year 21, primarily because of the lower cost of borrowing. This is the first time the company has ever reported a positive PAT at 325.9 million in a seasonally weak quarter such as quarter 4. This has primarily led by improvement in profitability of international operations and lower financing costs. For the calendar year 21, PAT grew by 108.8% to the level of 7,460.5 million rupees. As along with India, most of the international territories also reported healthy profitability. On the balance sheet front, the net debt stood at the level of 30,053 million as on 31st December 21 as against 30,158 million as of 31st December 20. The debt reduced marginally despite increase in capital work in progress of by 4,300 million and incremental stocking of PET chips preforms of 2,000 million rupees as on 31st December for the next season in order to mitigate against logistics and pricing risks. Our debt to equity ratio stood at a healthy level of 0.72x, and the debt to EBITDA ratio stood at 1.82x as on 31st December 21. Working capital days increased to 35 on December 31st, primarily because of higher stocking of PET chips preforms. During calendar year 21, net Capex stood at 3,500 million, out of which rupees 1,300 million is primarily towards brownfield expansion in certain plants in India, and 2,200 million is primarily towards brownfield expansion in Morocco and Zimbabwe. As on December 31st, 21, capital work in progress stood at a approximate level of 5,000 million, primarily for setting up new greenfield production facilities in Bihar and Jammu and brownfield expansion in Sandila factory. In line with the guidelines of dividend policy, the Board of Directors recommended an interim final dividend of 2 rupees 50 paisa per share during calendar year 21. Total cash outflow for dividend payout was 1,082.6 million rupees. On the whole, the company's financial position remains strong we have seen a healthy month-on-month trend in sales and consumption, and the outlook remains positive for all our product categories over the medium to long term. Overall, the focus remains on generating strong free cash flows over the ensuing quarters and coming years. On that note, I come to an end to the opening remarks and would like to now ask the moderator to open the forum for any questions or suggestions that you may have. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and one at this time. The first question is from the line of Chirag Shah from CLSA. Please go ahead.
Thank you for taking my question. At the outset, congratulations on reporting profit in Q4, a difficult to achieve task. Just very quickly, Mr. Gandhi, you mentioned that the focus going ahead would remain on generating strong free cash flow. Can you just touch upon what will be the Capex trend in the next couple of years? What will be the investments in some of the newer geographies that you are planning to enter? And then finally, what is the plan to improve further on the working capital cycle, please?
Thank you, Chirag, for asking this detailed question. First, on the operating free cash flows and the Capex going forward, as mentioned that this year the Capex planning was 2 greenfield and 1 brownfield project at 3 locations. And the Capex breakup, as given in the last call of 700 crores, is going to be there. And out of it, about 500 crore is already incurred. And but what is more important than the year-wise breakup is that in the longer term, we always give the guidance that our Capex is going to be on a long-term basis, whether we see last 5 years or on a moving basis, somewhere around the depreciation figure, which still holds true on a longer term basis. This Capex of 2 plants is coming in the light of last 2 years there was no expansion, one. Second is new territories, new geographies opening up. This is, as of now, there is nothing, no Capex plan for new geographies. But that inorganic, as and when the opportunity comes in, we definitely share with all the market bankers, everyone. And as and when, it will come, we will definitely be doing it. And I think you had one more question, Chirag? Working capital cycle. Yeah. Working capital remains always, with every volume going on and every year is improving and improving. And standard basis, it's about 14 days. And 31 days at the year end is one, the volume in December low months is lower. As it shows 21 to 22 days. And it got accelerated with our conscious decision of de-risking the company by stocking preforms as well as the PET resin to de-risk against the logistic or price issues. And although luckily the third wave is subsiding now fast, but initially it was not possible to predict, but we wanted to protect ourselves, which we did. Yeah.
I understand. I understand the one-offs that we have on the inventory days, but on a structural basis, as the juices capacity also gets spread across India, is there a scope to reduce the inventory days that we have in the system? The normalized inventory days, I mean.
No, I think less than 14 days will be very difficult. I think 14 days is very, very optimum, and I think it would not get reduced further.
Sure. I'll take it offline. I was just talking about the inventory days, but I'll take it offline. Ms. Vepuria, since we have you here, can you also talk about the dairy expansion plans now? And secondly, the expansion plan from the PC cooler rollout, please?
So our dairy expansion, because of the last 2 years of COVID being in the peak season, so we really couldn't do very much with it. So this year, hopefully, if the things work out well, we have a large plant in Pathankot and partly in Arunachal. So not Arunachal, sorry, Asansol, where we are producing dairy products. And hopefully this year our volume growths are expected to be more than double to maybe even triple. So once we reach that, then we would be looking at putting up another unit in Maharashtra.
Understand. And on the VC coolers?
We have estimated 40,000 VC coolers.
VC coolers, we are normally putting about 40,000 VC coolers every year, so which we have done this year also.
Sure. Sure. Thank you. I'll join the queue. I have few more questions, but I'll join the queue. Thank you.
Sure.
Thank you. The next question is from the line of Nihal Jham from Edelweiss. Please go ahead.
Yes, thank you so much, and congratulations to the management for the strong performance. So 3 questions from my side. Starting off with the quarter, ideally we have been discussing about the out-of-home and in-home split. And considering that you mentioned that this quarter you did not see any impact coming in from COVID, is it safe to assume that the out-of-home and in-home split is similar to what it was pre-COVID? And also if you could highlight, the performance of certain star products like Sting or any of the others you may want to.
Yeah, fundamentally this last quarter we had practically started coming back to pre-COVID days with the normal system. And the split on the go was 65% and 35% home consumption. So that is what the split has been on a normal working.
That is helpful. And then just to understand any specific product categories, would want to know about Sting's performance and if possible to share the contribution for this year now that we've seen decent time period since it has been launched.
So Sting has done extremely well for us, and it's already close to 5% of our mix, and the volume has been phenomenal. So 5% of our mix itself is a large volume and still growing at a huge pace.
Absolutely, Mr. Jaipuria. Mr. Jaipuria, the second question was
just for your information, the growth has been about 440%.
Better off than the share of this last year would have been just less than say 1 to 2%?
Absolutely. So, with a 440% growth, I don't have the exact number what the mix was last year, but this has really gone up, and it is still doing extremely well. We hope this share will further go up this year.
This is very helpful. Mr. Jaipuria, the second question was in terms of, you didn't mention about the visi-cooler, just in terms of the retail touch points, I think we ended last year at around 2 million retail touch points. Just to get an update that what was that number at the end of this year, in case that's available?
The retail outlets remained more or less the same because of the COVID year, and the visi population 840,000, out of which was covered by our visi presence in those outlets.
Because a lot of outlets temporarily shut down, which have still not opened actually. So a lot of restaurants and all are still not back to operation.
Right. So for the coming year, what are we building in? Would we like to say catch up given the miss in the COVID year that we would want to add say 300 to 400,000 outlets higher than the past run rate, or are there any internal targets on this front?
Well, we hope to add about at least 10% to 12% outlets. And of course, if the outlets which have shut down also open up, so it will be much higher. But a lot of restaurants especially, we are not sure if they will open up or not. So we are still waiting and seeing what is going to happen. And unfortunately, January had a COVID base again, so it's still too early to say. Luckily, it has not impacted us this time because the lockdowns were not severe. So as long as we don't have severe lockdowns, then it's not a problem for us.
Moreover, last 2 years, COVID waves were during the peak month, and this year COVID wave 3 was in our weakest month of the year.
Absolutely. So just one last question from my side. This quarter towards December, you did mention about entering Congo, which is a bit of a different setup than what we traditionally entered some of the other geographies. So if you could just comment on that, and could that be a way of entering some of the other African markets, and also the setting up of the subsidiary in Dubai, if that is anything you may want to highlight to us, and I'll be done.
Well, basically, we are just at the finalization stage of entering Congo, but initially for a year and a half at least, we will be distributing product there. We have capacity in our plant in Morocco and our plant in Zambia. So we will be supplying two parts of Congo, one from Zambia and one from Morocco. So we will be, which will help both these countries in utilization of their capacities.
As you will notice from our filings, that we will just be testing the market, and we will be importing and supplying. And while importing one territory which will be supplied out of Morocco, the off-season of Morocco coincides with the busy season in DRC. So we want to leverage our existing facilities without any Capex initially. And if it turns out to be promising, we will not shy away from considering for the Capex. And on the second filing of the office in UAE, which you were mentioning, that is only a coordination, because it's, DRC is not going to have any manufacturing facility, and two countries will be supplying. So the coordination and that becomes easier from a place like UAE. It's only that objective.
Understood. Wish you all the best. Thank you so much.
Thank you.
Thank you. The next question is from the line of Kashyap Javeri from MK Investment Managers. Please go ahead.
Yeah, thank you very much, sir. Two questions from my side. One, if we look at our standalone numbers, there is about 30% revenue growth and barely any, EBITDA growth on Y&Y basis. So in standalone, ops, if you could throw some light on the margins as well as the volume growth. And in the domestic market, or let's say India operations, how would the growth be split between, the three product lines in this particular quarter?
See, India, the volumes growth over 20 was 27.2%, and then we had packed growth of 61.9% in India, while in the international market, volume growth was 32% and packed growth was 17.2%.
Sorry, you said India packed growth of 61%.
27.2% on the sales volume and 61.9% on packed. Yes.
Okay, and international?
32% on the volume and 17.2% on packed.
Okay, and in both the businesses, would margins have behaved differently on per unit basis?
This is for the quarter, I am saying.
Yeah, I'm asking for the quarter only.
Yeah. Which is the next question, please?
And second question is that in India operations, what would be the volume growth across three categories?
India, the volume growth only I said 27.2%.
Right.
So
no, I'm saying the hello.
Yes.
I'm asking the growth split between CSD juices and water.
Okay. The split in calendar 21, CSD is 70.3, juice 6.4, water 23.6. This is on overall basis. If you want to split between India and overseas.
Can you repeat those numbers actually?
This is the mix. 70.3% mix of CSD. Juice mix is 6.4. Water mix is 23.6.
This is on overall basis.
This is on overall basis.
And would you have that number separately for India and international ops?
We do have.
I think right now we have a combined number, so.
Okay.
Yeah.
Sure, sir. That's it from my side.
Thank you.
Thank you. The next question is from the line of Dhruv Zimbajka from Monarch AIF. Please go ahead.
Yeah, thank you, sir. Thank you for the opportunity. So my question is that when I see the standalone and the consolidated numbers, the India PAT for this calendar year is 489 crores, correct?
Yes, that's right.
And last year, which was 226 crores.
That's right. Registering 116% growth.
Right. And similarly for international, it has jumped from 103 crores to 257 crores.
That's right.
Okay, so sir,
30.8 to 256.
Okay, so how, why do we see this big jump, sir? What has contributed mainly to this jump in international PAT for us?
The international
volumes have gone up.
The volumes have grown up, and over the last year, PAT growth international is 96, India is 116%. So both are in line actually.
Okay. Okay, sir. If I see the realization per case in the international market, so last year it was 179 rupees per case, and this year is 193.7. So again, wanted to get a sense of what is the volume mix for us in the international market that we are generating this kind of a realization, which is better than India.
Because the pricing has been, we have taken some price increases internationally, and that is why you see, because of the PET, and we have passed it on to the consumer. So that's why you see.
Okay. And sir, just last question. On the volumes front for the India business, do you have the absolute million cases number for CSD, NCB and water?
Well, the total volume is what?
India 316 for the CSD, juice 33.4, water 105.
Okay. Fine, sir. Thank you so much. I'll come back and
Thank you.
Thank you. The next question is from the line of Sanjay Satpathy from Ampersand Capital. Please go ahead.
Yes, sir. So thank you for the opportunity and congratulations on a great set of numbers. So I have two questions. One is that for your company, are you gaining market share? Can you give us some color on market share trend for different product of yours?
I think both the companies are doing well. I think we are in the range of 0.5% up or down. So both the companies are growing at a reasonably fast pace. Whole industry is growing. So we haven't got the latest results, so I don't know. But we're definitely not losing any market share.
Okay. And my second question is that in the opening remark you mentioned that you are looking forward to far better performance going ahead. Is there any way to kind of quantify it, or are you looking at better volume growth or margin expansion? What really are the drivers of your optimism for next year?
One, I think, is clearly that the last 2 years we have gone through in our peak season, which has been pandemic, and we hope that this year is not going to be the same. So we expect a major growth in the second quarter of our, which has been both years affected by the pandemic. And that itself will give us a bump in our overall volumes, and that with the volume growth automatically our margins as well as our PAT and EBITDA will go up. So we expect a very healthy growth this year, and we have been able to mitigate most of our cost which has been increased by PET by lightweighting the preforms and also partly passing the consumer price to a little bit. So we have got enough resin for our this year. So I don't see any further challenges for us as far as cost escalation is concerned.
So thanks a lot for this. And so overall, what kind of, I believe that earlier you were looking at some 20-21% kind of EBITDA margin as a sustainable margin. Is that something which one can look to?
Yes, I think we can definitely look at something in that range going forward.
Okay. And so if I can just ask one more question, that you talked about this competition, and that both of you are kind of not kind of considering any inch to each other, it looks like. So in that kind of circumstance,
we are trying not to. I don't know if we are, but.
Okay. But the fact that you are getting into Bihar and couple of others, so this is the kind of geographical thing that you are doing. So overall, I thought that you might be gaining market share.
Well, we hope we are trying, but I don't have full numbers to say that we are. So I don't want to say it, but I think we are doing reasonably well, and I think the other company is also doing quite well. That's all I can tell you.
Okay. And there was no impact of this Omicron wave on this latest quarter?
Pardon me?
This latest quarter, there was no impact of lockdown or anything, right, sir? The quarter in which was December.
Last quarter, no. October, December, there was no effect of.
Thanks a lot, sir.
Thank you.
Thank you. The next question is from the line of Devanshu Bansal from Emkay Global Financial Services. Please go ahead.
Yes, hi. Thanks for the opportunity and congrats on really good set of numbers. Sir, can you give us some color on January trends, as in how have been the trends in January, because this was a relatively more impacted month?
No, as I said before, that we are, unless until there are major lockdowns, we are not getting affected, and we are, I think, back to our pre-COVID days. So we are looking at a very positive year, actually.
Okay, and in December quarter, we have seen about 17% volume CAGR on a 2-year basis. And in previous quarters also, as we've indicated that the volume growth in non-impacted months has been upwards of double digits. So with assuming that CY22 is going to be a normal year, can we base this growth into assumptions for coming years as well?
Well, definitely this year will be, the growth will be much higher, provided we don't get any pandemic again and they are not lockdowns. And as I said, we expect a very healthy growth and a very healthy margin, which is 20-21% growth margins. And because last 2 years we've had a bad second quarter, which is our main quarter. So if we don't have pandemic this year, we should have a very healthy quarter, and going forward for the full year, it will be a great year.
Okay, so just to reframe the question, so in current year season quarter, if things remain normal, can we see sort of a 10-12% sort of a CAGR relative to pre-pandemic levels in the June quarter?
Let me give you one data point, and rest, we'll leave on you to extrapolate. In 21, when Delta came on peak in May 21, the volume was 66% lower than 2019, and overall we had grown. So we definitely feel it will be higher than 2019, and rest of the month you take the volumes and you can work out what growth in the second quarter we can expect.
Sure, sir. And there has been a change in revenue mix as well as improved international realizations that have led to overall realizations to improve. As this revenue mix normalizes, so should we see this our overall portfolio level realizations to moderate slightly in the coming year, or we can still grow over the CY21 levels?
So this is a continuous process. Will keep on growing. As and when new packs, new sizes, new things are introduced, they always come with a premium. Like Sting, which is 5% of the mix, comes at a good premium to us.
If you look at our products which are growing faster, is Sting, which is a premium product, Dairy, which is a premium product, Tropicana is growing at a faster. So all these products are premium products. So that's why, and we expect a much better year this year. So that will all bring in healthier top line and as well as the bottom line.
Sure. And my last question is, sir, we indicated that this Zimbabwe currency reversal provision should continue for like 5-6 quarters. And this quarter, I think we have not reversed about $2 million of this provision. So anything on this front you can highlight?
Yes, we out of 130, if my memory goes right, I think 52 crore we have already reversed in the balance. As in when, based upon that quarter's currency rates will keep on, amortized. This quarter's currency movement was such that, there was no reversal, but whatever is left has to fall through the P&L account in due course.
And what is this 33 crore other income in standalone financials?
In fact, Varun, India gets dividend from its subsidiaries, mainly from Nepal. That is recorded as other income.
Okay, sure. Helpful, sir. This is it from my end. Thanks.
Thank you.
Thank you. The next question is from the line of Deepak Lalwani from Unifi Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. Sir, just wanted to understand how much price hike have you taken in this quarter?
So it's not very much. On couple of packs wherever there was room we have taken, which is basically to mitigate our PET resin input cost by lightweighting and the second by taking a price increase. So we have basically mitigated it. So this year we will not have much impact, and that's why I said we will still have a 20%. We will still be able to maintain our 20% EBITDA margins.
Okay. So just wanted to understand a little deeper on your pricing mechanism. So how does the company think about price hike? Like, does it depend on competition, or do we need to take a pre-approval from Pepsi or something like that?
No, we don't need a pre-approval, but of course it depends on how the competition is behaving. It's not because we have to see what the market can take and where we can put it. So whatever we feel the market can accept, and that is the price increase we take normally.
Got it, sir. And sir, since next year is going to be a good year in terms of free cash flows, what is the debt reduction target for CY22?
We are from 3,000 at least, somewhere about 40% or so we should be able to reduce.
Okay, sir. That's helpful. And sir, if you could share the the percentage of revenues coming from Tropicana and the dairy segment, and what has been the growth rate in this year?
Tropicana mix is 2.3% and Sting is 5%.
Okay, and what about the dairy business?
Dairy, we could not launch in the proper way because of the COVID the day it was launched. It's negligible, and but it's promising for the current year.
Got it, sir. Thank you. That is helpful.
Thank you.
Thank you. The next question is from the line of Sumant Kumar from Motilal Oswal. Please go ahead.
Yeah, hi, sir. So can you talk about the overall growth in rural and urban market for our products?
Urban has slightly behaved better than rural. Otherwise, there had not been much of a change between the two. It was broadly in line with the overall growth level.
So, rural is growing at faster pace versus urban?
Slightly lower than the urban.
Urban has been growing slightly faster. And that is mainly because of the COVID happening in the peak season, which is where the rural is much more buoyant.
Not because of base effect also, the rural has a lesser impact in Q4 CY21.
For our volumes are very low in rural. You see, the main volumes which come from rural is in the peak season, which is April, May, June.
Okay.
And because of COVID being in end of April and May, that got affected quite badly.
Okay. So particularly this quarter also, rural is lagging urban growth.
No, not this quarter, but if you look at the year, that's where the lagging is coming. So hopefully this year rural will be much faster growing than urban.
When talking about the current scenario in Q4 CY21, how is the rural and versus urban particular quarter?
So the growth has been about equal. So there's not been negative in the rural. It started coming back.
Okay. Thank you so much.
Thank you. The next question is from the line of Sameer Gupta from IIFL. Please go ahead.
Hi, sir. Thank you for taking my question. Just a clarification. So you mentioned 27% volume growth in the India business and 31% is the sales growth. So that's a difference of 4%. Suffice to assume this is the kind of price hikes taken this quarter?
Internationally, the realization has been better. That's right.
No, not international. Domestic, I'm saying.
Domestic, for the quarter, 27% increase and 31% in the realization.
So actually, realization is better.
Yeah, so this is suffice to assume that this is the
product mix which is changing, no? So Sting has increased, which is a higher value product, and Tropicana is a higher value product. So.
Okay, so this 4% difference is largely on account of mix, and that is what is reflecting in this number.
Yeah.
Okay. Sir, another clarification on Tropicana. You mentioned 2.3% of sales. This only pertains to the juices and nectars, right? Doesn't pertain to the slice or whatever fruit drinks that are sold under Tropicana, right?
Not slice. It's only juices and nectar.
Okay, sir. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Nikhil Parekh from Samohara Investment Managers. Please go ahead.
Thank you so much, sir, for the opportunity. I'm sorry, sir, if it is a repetition. Can you please share with us what is the price hike you would have taken for this calendar year 21?
As I said, we have not taken a price hike initially. It's only in the later part, which is maybe in December, we have taken a minor tweaking in pricing, and balance we have mitigated by lightweighting the preform.
Okay. And second question is, sir, on the south and west markets. Sir, I wanted to know what would be the contribution to our CY21 volume. And if I recollect the numbers, I think it was about 160 million cases market when we got it from Pepsi. So just wanted to know what numbers we would have done this year, and what are the growth opportunities ahead.
Well, south and west is growing quite well for us, and it has been 142 million against what we had taken in from Pepsi, which was much lower than this.
So what is the growth we are expecting? Because if I'm recollecting the numbers, I think 180 or 190 million cases was our target.
The last 2 years, both the years have been COVID years, so you can't expect a growth actually. So that's why the growth has been very little, but it's been still better than what we had taken.
Okay. And in terms of improving the go-to-market strategy,
we have grown 33%.
Sorry, sir?
We have grown 33% in south and west over last year.
Okay. And in terms of improving the go-to-market strategy, that is still an ongoing process, or
you need to, we've not had one proper year, and our business is skewed to April, May, June quarter, in which both years have got disturbed. So hopefully after this year, I'll be able to give you much better answers.
All right. And sir, one last question is, if you can share the absolute volume numbers for Sting.
5% of our total volume.
Okay, 5% of total. Thank you so much for answering my question.
Thank you. The next question is from the line of Sanamdi from H West Company. Please go ahead.
Yeah. Hi, sir. Am I audible?
Yes, very audible.
Sir, I just wanted to understand that as 2 years back, Mountain Dew was on the counters of main shops or any showrooms, mean to say showrooms like restaurants. But now the thing has changed. Are you looking in that way or are you looking in the different way? Mean to say, are you willing to fill the gap with the Sting, the gap which is realized in the Mountain Dew, or are you viewing it in different way?
So why do you feel there is a gap in Mountain Dew? I didn't get you.
Well, I'm just asking that as I go to any shop in the village or any city, then they said that Mountain Dew is losing its market share in the sense of its taste, and Coke is gaining the market share in spite of Dew. So I'm asking in that point.
That is not true. Mountain Dew is very much doing well, and we are quite happy with it. And Sting is adding additional volumes to it, and that's why you're seeing such large growth.
You have to see like this. If I had grown 33%, so the growth is coming with Sting and other things, which are facilitators for growth. So if Mountain Dew, which is always a winner, if it's coming down, I'll never be able to grow.
Okay, sir. Okay. It is looking in your financial. Okay. Thank you, sir. Okay.
Thank you.
Thank you. The next question is from the line of Kunal Shah from Jefferies. Please go ahead.
Yeah, thank you for the opportunity. So, sir, I have just one question. So, I understand our debt levels increased because of higher inventory and some part of Capex sitting in CWIP. Any trajectory guidance that you would like to give for debt going forward, given our CY22 is looking up in terms of operating performance and cash flow and everything?
We expect at least the debt to come down by at least 1/3, if not more.
After taking care of organic Capex for the next year, at least 40% it should come down, if it's not more. It can be 45% coming down from this level.
Got it. Yeah, that's all from my side. Thank you.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question at this time. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Abhisar Jain from Monarch AIF. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. Sir, can you give some update on the Capex progress in the Bihar location that you have taken up? By when is that expected to get commissioned?
Bihar and the Jammu plants we are expecting to be ready before our ensuing season. We always plan putting up the plants so that we can immediately take advantage of it.
I think by March we should have both the plants operating.
Right. So, sir, basically for the season we should get the positive impact, and you had given that those locations have much lower per capita, and that's the growth area which you can realize, right?
Absolutely. So both the plants, Bihar, J&K, and our expansion in Sindila will be all completed before March, and it will be in production.
Sure.
In fact, we need to plant very badly because one, the Pepsi's penetration is very low. Second, per cap is very low. Third, in those territories of Bihar, Orissa, Chhattisgarh, Jharkhand, MP, that belt is growing 50% plus for us every year after year.
Right. Sure. And sir, I also wanted to understand now the company's direction going ahead, since we can enjoy some normal years starting CY22 hopefully. So on the balance between growth and debt reduction, what should be the direction that we should assume? Because if at all, you pursue any other growth opportunities, say in international market, then the deleveraging could be lower than what you had just indicated, right? So, what would be the direction that the company would like to go over the next 2-3 years? Could we look at further growth opportunities after only, achieving some level of deleveraging, or we'll see it on a opportunity basis?
Well, if you look at it, we are not really leveraged that much anyway. But we are always looking for new opportunities, and as and when, as Mr. Gandhi had said, we find any good opportunity, we'll definitely take it because our balance sheet is more than healthy to support it.
And moreover, there is no M&A after May 2019.
Right. Sure, sir. Understood. Thank you so much and best of luck.
Thank you.
Thank you.
Thank you. The next question is from the line of Kashyap Javeri from MK Investment Managers. Please go ahead.
Yes, sir. Thank you very much for this opportunity. Just to clarify on my earlier question, you mentioned about India operations. There was a 61% you said PAT growth. Like what you're basically mentioning is actually the decline in losses, right, for the quarter?
So this quarter,
52 crores to 20 crores.
Which place?
The quarterly number which you mentioned for India operations.
That's right.
If I look at our revenue growth is about 31% on 27% volume growth. But if I look at the EBITDA number, that number is actually sort of flat versus last year. So, was there any EBITDA per case contraction in Indian operations?
This is because of the input costs going up. This was the effect in this
So
quarter.
this was the quarter where all the cost of PET resin actually went up. And that is why during this quarter is by which we have lightweighted, and the effects of that will start showing in January onwards. And we have also increased our price in the end of pretty close to end of December. So those effects will also show this year.
This is in India market, domestic market.
India market.
And if I look at your, global operations, which is Africa and some Nepal operations, there, despite the similar kind of growth, in revenues, the margins have, sort of held up in those geographies. So, would it be product mix?
Much earlier. There we increased the prices much earlier, and in India we could only increase at the end of December practically.
And that should reflect in first quarter this year numbers.
This quarter it will reflect.
Okay. And international operations, because we had already taken a price increase, that should continue steady state in the first quarter of this calendar year.
That will continue.
Okay. Yeah, that's it from my side, sir. I just needed that clarity. Thank you.
Thank you. The next question is from the line of Anirudh from JM Financial. Please go ahead.
Hi, thank you very much, Mr. Jayapuri and Mr. Raj. Two questions from my side. If we look at the volumes that were delivered in 2019, will it be fair to assume that this year the volumes will be, in absolute basis, higher, given that we are expecting a normal summer season domestically as well as internationally?
Domestically more, internationally less, because the lockdowns internationally were much lower. And the timing, it was winter internationally when it was peak summer here.
And how should those volumes behave?
So internationally, I don't think it will be regular normal growth which we are getting, whereas domestically you'll see major growth.
Okay. And second is, to what extent would you have the pricing power in terms of, so if you were to say, take a 5 or 10% price hike, what can be the effect on demand? Or even if you were to take
it's all relevant, we have a competition. So question is, I can take a price increase, but if the competition doesn't take it or match it, then we have a problem. So we'll have a problem in the market. So we can't take price increases just like that. So we have to be very conscious of how we take price increases.
But in the past, how has this pricing decisions been playing out?
Well, somebody has to take the lead, and one of us takes the lead, and the other one mostly follows. But there's no hard and fast rule to it. It can be a call by any company what they want to do. Okay, and if the other person doesn't increase, then you end up discounting it to match it.
Okay, just to understand this a little bit, till now, what percentage of the raw material inflation you would have, kind of covered?
So we have covered all our inflation, and we have covered our raw material also. So we don't see any challenges for 2022. That's why I said our EBITDA margins will be healthy, and we are looking at again 20% plus EBITDA margins.
This is fantastic. Thank you so very much.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments.
Thank you. I hope we have been able to answer all your questions satisfactorily. Should you need any further clarifications or would like to know more about the company, please feel free to contact our investor relations team. Thank you once again for your interest and support and for taking the time out to join us in this call. Look forward of interacting with you soon. Thank you.
Thank you. On behalf of Varun Beverages Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.